Chapter 3 Analysis of Financial Statements. The topics in this chapter include ratio analysis, ratios, common size statements, percent change statement, DuPont equation, limitations of ratio analysis, and qualitative factors. Overview. Ratios facilitate comparison of one company over time and one company versus other companies. Profitability ratios. What is the company's rate of return on sales? Profit margin, operating profit margin. What is the company's rate of return on assets? Basic earning power, return on asset, and return on equity. Asset management ratios. Those ratios measure how efficiently does the company use its assets, and how much does the company have tied up in assets for each dollar of sales. For example, daily sales outstanding is an average number of days from sale until cash received. It's receivables divided by average sales per day. Fixed asset and total asset turnover ratios. Liquidity ratios measure can the company meet its short-term obligation using the resources it currently has on hand. Liquidity ratios include forecasted current and quick ratios. Current ratio is measured by current asset divided by current liability. Quick ratio is current asset exclude inventory, but divided by current liability. Debt management ratios. It measures does the company have too much debt? Can the company's earnings meet its debt servicing requirements? Debt ratio include leverage ratios. The debt ratio is the total debt divided by total assets. The debt to equity ratio is total debt divided by total equity. The liability to assets ratio is the total liability divided by total assets. The equity multiplier is the debt to equity ratio, which is the total asset divided by common equity. Times interest earned ratio is the EBIT divided by interest expenses. EBITDA coverage is the EBIT plus depreciation, amortization, plus lease payment divided by the interest expenses plus lease payment and a loan payment. Market value ratios incorporate the high current level of earnings and cash flow increase market value ratios. High expected growth in earnings and cash flow increases market value ratios. Market value ratios include book value per share and market to book ratio. The simple version of the DuPont equation include return on assets equal to the net income divided by total asset times the total asset divided by equity, which is a return on asset times equity multiplier. The extended DuPont equation, return on equity is equal to profit margin times the total asset turnover times equity multiplier. Potential problems and limitations of ratio analysis. Comparison with industry average is difficult if the company operates many different divisions. Seasonal factors can distort ratios. Window dressing techniques can make statements and ratios look better. Different accounting and operating practice can distort comparisons.